Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
For the moment, with the markets actually largely flat and quiet, let's discuss medium-term cues. Our market master, Mihir Vora, Director and Chief Investment Officer, Max Life Insurance, has joined us. Good morning, Mihir. Thank you very much indeed for joining us. Would you say this is going to be the texture of the market? Not much movement at an index level, supports being bought, but anything closer to 11,000 looks tough?
Yes, we are in a very interesting position because local flows are so strong. The local, I would say the local speculative and HNI positioning is also very light, especially after the sharp correction that we have seen in mid caps. So I think overall positions are very light. On the other hand, you have FIIs which are still which are still selling all over the emerging markets. So I think it's a tug of war going on, and probably we should see this kind of consolidation for a while.
Okay, this kind of consolidation, but there are plenty of money-making opportunities in this market, Mihir. We were just talking about how the consumption space has suddenly found a new set of wings, despite being quite expensive. You know, the Bata, Pidilites, Page Industries of the world. Do you see more value here?
Well, as a theme, we've been discussing for quite some time, probably the last couple of years, that it's only been consumption and government spending which have been holding up the economy. Capex has not really been a growth area, so to say. So I think the fancy and the polarization of the market continues. And if you look at the width of the market, that is a point to worry about. You know, if you just look at the FITD performance of the Nifty, 9 stocks account for 100% of the movement of the Nifty. The balance 41 stocks actually have contributed negatively, and that is a broad reflection of the market also, where we are seeing a rush towards the favorites. So I think the price momentum strategy has worked very well for the last few months, but that may come to an end at some point in time.
Well, yes, the market's breadth has been a bit of an issue, and of course in broader markets that's even more visible. Mihir, good morning. So in that case, what should a mutual fund investor do after having seen a stupendous 2017 where NAVs went up 40, 50, 60%? 2018 has been a year of course, mean reversion. What's the call now in terms of how to approach this market?
So as a mutual fund investor, probably you don't need to worry too much because the fund managers are there to do the stock picking for you. And there is a positive side to this divergence in the market, which is that some stocks have become so cheap because of the huge divergence that we've seen, that the alpha generation opportunities actually are getting created as we speak. So I think as a long-term investor, given the fact that we are what we are as a country, growing at 7 to 7.5% over the long term, valuations probably on an aggregate look expensive, but as I said, because of the divergence, there is adequate scope for stock picking. And given the low base of last year, for the next couple of years, at least earnings growth should be healthy. So to that extent, we have pros and cons, but not too much to worry for a long-term investor.
Okay. Mihir, how would you approach the entire finance space, banks and non-banks? Non-banks have a problem in terms of rate increases. Banks have a problem in terms of, bad loans. So do we stick with the expensive private sector banks, or are you looking beyond it?
So I would stick to the private sector space in general. I'm not actually too much worried about the NBFC space also, because since the PSU space is getting vacated because of lack of capital, both private sector banks as well as the NBFCs will have a field day grabbing market share, and we've been discussing this for quite some time now. This is a theme that is going to continue, and when you have a large chunk of the market up for grabs, I don't think pricing should be an issue. So even though wholesale rates might be going up, spreads may not get impacted to that extent. Earlier, NBFCs used to participate mostly on the retail side, but now the SME and even the larger corporate structured finance space is opening up very rapidly, because again the large banks are not there in that segment anymore. So I don't see problems for the private sector as a whole, both retail as well as for the corporate lending part.
Okay, well, the space to be in this morning definitely is IT. TCS and Infosys have now hit new highs and are just charging ahead. TCS is up 1.5% and so is Infi, both at fresh highs, big volumes there. Mihir, on IT, you think the run is nearing an end, or is there a lot more to go in this upcycle?
may have some more steam to go, in my view, because the sector did underperform for quite some time before it started outperforming in the last 6 months. So to that extent, valuations are not obscenely expensive. These are good cash flow generating companies, and in volatile times, investors will flock to these kind of stocks. So I think there may be some steam left in this segment too.
And to flock into pharma as well, Mihir, you would think?
I think so. As we discussed earlier, probably the worst is behind us, both in terms of the FDA issues as well as in terms of pricing. And even if pricing pressures in the US do continue, I think the Indian pharma companies will be the last man standing, so to say. And I don't think volumes will be an issue. So I think for a patient investor, this would be a space to look at definitely.
Okay, what about banks and NBFCs? We have such a narrow move with the same HDFC Bank, IndusInd Bank doing well. The PSU banks, of course, have destroyed value. In NBFCs, we have had a Bajaj Finance, which has been a league of its own. But there are others where we have seen massive correction, the likes of Canfin Homes. Your thoughts on how to approach financials?
So as I said, broadly speaking, we are positive on the private sector space as a whole. But valuation-wise, we are more comfortable with the banks. The corporate-oriented retail banks, the corporate-oriented private banks, as well as the retail private banks, we are positive on. NBFCs, we've been finding it difficult to find a value because while I do believe pricing power will be here to stay, valuation probably is more in favor of the private sector banks rather than NBFCs. So our portfolio comprises mostly of the banks, both corporate banks as well as retail banks.
Mihir, would you dare and venture into infrastructure now at all? I mean, I know there are only a couple of power companies which are worth mentioning, but it's been beleaguered so much, and you are in insurance. You think 30 years, you think 20 years. Is there value emerging in these completely beaten down sectors, say real estate and infrastructure?
So in infrastructure, we are sticking mostly to the construction companies because that's where you can see some cash flow generation, where you can see some growth visibility because of government spending. The asset owners tend to get negatively impacted in a rising interest rate cycle, and moreover, the asset owners are directly or indirectly regulated on how much ROE they can make ultimately in the long term. So for a long-term investor, if you're looking at a compounding story, probably asset owners are not the space to be in. We'd rather be in the construction space. On real estate, yes, selectively there is some pickup happening in pockets. So we are picking and choosing. We don't have much exposure, probably about 1% or so in the segment. But yes, for the players who have managed their balance sheets well in the real estate space, there is definitely room to grow, and we are picking those stocks.
All right, Mihir, always good talking to you. Thanks a lot for your time today.